Hey everyone, me Kevin here, brought to you by Extra. Go to metkevin.com/extra to learn more. All right, folks, so something wild happened today. We gotta talk about what James Bullard, the president of the St. Louis Federal Reserve, had to say today, and the potential warning sign that is starting to brew in the market. We just had an inflection point on something very, very important that very few folks are talking about, so we're gonna talk about that towards the end of the video. But first, James Bullard, president of the St. Louis Federal Reserve, a voting member of the Federal Reserve's Open Market Committee. That's the body that votes on how much and when to raise interest rates, how much and when to offload the balance sheet. Well, this morning, in a discussion with Bloomberg News, stated that he now supports raising interest rates by 1% by July 1st. Now, given that the July Federal Reserve meeting isn't until July 27th, that actually means Bullard supports rates going to 1%. Forget about 0.25% or 0.5% to 1% within the next 3 meetings or potentially even sooner. So right now, this on sort of a base case scenario implies 3 successive hikes. Likely 50 basis points or 0.5% in March, followed by a 25 basis point increase in May and another 25 basis point in June. He also says that the Fed should remove accommodation for markets as soon as possible, because right now we're actually still stimulating. Now, 1% rates are still accommodative, but we are still stimulating. We're still printing money right now, which is just nuts. Meanwhile, the Fed is so far behind the curve on inflation. Companies have lost faith, and now they're raising prices more than ever before, more than last year, at least what we're seeing in Q1, because they have to. They're behind the curve. The supply chain and transitory inflation's arguments aren't really keeping up right now. So there's now this possibility, because of what Bullard implied about maybe even an inter-policy meeting, there is this possibility that the Fed will call an emergency meeting. And this is what's really spooking the markets today, and this is why we're seeing a lot of red in a lot of different stocks. Even though Bullard says he doesn't believe in the Bill Ackman shock and awe approach, Bullard suggests that we could have an intermeeting move, which basically could mean jacking rates up instantaneously to 1%. Now, Jerome Powell usually doesn't like doing that. So if there's any good news here, it's that Jay Powell likes steady Eddie and predictability at the Fed. This has been his promise that they're going to communicate more clearly. If things change, they're going to communicate these clearly and well in advance. That's always been the goal of the Fed. But unfortunately, well in advance has sort of left the Fed lagging a lot. Now, think back to the last time the Fed did something really unexpected. You go all the way back to the beginning of March, the first week of March 2020, and that's when the Fed sent interest rates from 2% to 0 instantaneously on a Sunday. Totally unexpected move. That was the day before I called up my lender and I'm like, the Fed just dropped rates to 0. Please refinance everything before other people go in, which was great because then I got my money by like the beginning, end of March, beginning of April, which was the perfect time to buy the dip in March of 2020. But now times are different. Now, you know this, I'm not the biggest advocate right now of buying the dip because I'm worried about this kind of pain continuing, but let's think about what this could mean. If the Fed ends stimulus all of a sudden out of nowhere and jumps interest rates in an inter-party meeting, the stock market could be in for quite a bit of a shocker. Now, again, hopefully that does not happen. I want to be bullish in that, hey, we can get to that soft landing, but I am really worried that they're just playing the violin for us on the Titanic, and I just want to be transparent about that. Now, we've got to talk, in addition to what we just talked about with the Fed, we gotta talk about another dangerous warning sign that just happened. And I hate to sound like Dr. Fudd, but I'm starting to get to the point where I just may have to embrace it. I'm Dr. Fudd and I'm writing you a prescription of caution. But first, so folks, let's talk about this other boogeyman in the room and what the market is doing right now. So yesterday, the market had priced in only a 24% probability of a 50 basis point rate hike. Today, following Bullard's craze and this terrible inflation report that we got this morning, the market is now pricing in a 99.6% chance of a 50% or a 50 basis point hike in March. They're pricing in 100% of a probability that will hit 1% by June. Now, Bullard is a hawk, so maybe they're getting a little ahead of themselves, and maybe that means we'll have some green ahead, because again, Bullard is a hawk. He's not as dovish as some of the others who have come out, like Marie Daly, who tends to say, hey, maybe we'll only need 2 rate hikes. Maybe it'll all be okay and we'll have that soft landing. But the market's pricing this in. We're seeing the red, and there's another boogeyman that we have got to talk about. And this has to do with the wage price spiral. This is when the price of goods and services rises and workers end up demanding more money. As long as workers have pricing power, their real wages tend to rise. That's a really interesting note. Think about that. If workers have pricing power, real wages go up. So we can now study the inverse. If real wages are going up, that means workers have pricing power, right? And most of us would agree workers have pricing power right now. And this all comes from the IMF's working paper on wage price spiral. It's an older paper. It's not from recent times here, but it tells us what to identify or what to look for to identify wage price spirals starting. And they say that wage price spirals start to happen when businesses seek to increase or maintain their profit margins by raising prices, and employees or workers seek to maintain their real purchasing power by demanding more pay. And so this is what's really interesting. If you look at what Cathie Wood told you just a couple days ago, she said, oh, year-over-year inflation data is 7% and year-over-year wage growth is 5.6%. That means real wages fell. That means workers don't have pricing power and we're heading towards deflation. Well, unfortunately, we've got bad news for Cathie Wood because we got the January employment report and today's inflation report. Both of them had something scary in it that folks aren't talking about right now. The CPI report said that wage earners saw their wages increase 8.2% over the last 12 months. That means real wages are now growing by about 1%. 8.2 minus where we are now, 7.43-ish, somewhere around here, 7.5-ish, with inflation, somewhere between 0.7 to 1% of real wage growth, which actually means individuals' purchasing power is growing. And the IMF tells us if wage pricing power. The IMF tells us that if wage pricing power is growing, we could be at the start of a wage price cycle. And that's a boogeyman that markets might try to unfortunately start pricing in. See, we also had the jobs report about a week ago that told us average hourly earnings increased 23 cents in January or 8.8% month over month, reiterating this about 1% increase in purchasing power. And now real wages are actually growing more than inflation, despite the fact that inflation is so high. This is dangerous because it indicates the start of the wage price spiral, which unfortunately could self-sustain high inflation until the Federal Reserve finally comes out and ends this nastiness by properly raising rates quickly. And it's going to be quite a bit of rate increases that we need because individuals still have more cash balances, so they don't necessarily have to borrow. And unfortunately, when we get the first rate increases, variable rates and lines of credit are likely to see their rates go up, which means actually input costs at companies could go up before demand goes down to end the wage price spiral and just inflation in general. Now, I know this is a lot to take in, but there's even more. Because there's this thesis that, well, supply chains will just resolve themselves. And this is where we end the video, right? Supply chains are going to resolve themselves and everything's going to be fine. But the problem is, the Wall Street Journal, on the front page today, says Toyota and Honda see lingering shortages, and they believe that supply chain issues will actually stretch throughout the year without getting better. As a result, you've got insurance companies who are also struggling for the same parts as manufacturers, like Travelers, Progressive, Kemper, and State Farm. All of them are raising their prices. That, by the way, is right next to that article. Car insurers rush to raise premiums. State Farm, in just the last 6 weeks, has raised rates 2 to 3% in just 6 weeks. That's a lot on an annualized basis. Progressive says they've raised rates 17% and Kemper is raising premiums 11%. But they've only raised it so far on 50% of their customers, so they still got work to do. That means more price increases coming. Now, there is some light, there's some positivity, and that, for example, was buried in the B section on the Wall Street Journal where, hey, Toyota's challenges aren't just supply chains, it's because they're transitioning. They're going to electric vehicles and, we want to go green. Unfortunately, going green, it doesn't really matter what the reason is, going green or EVs or whatever, all contribute to more complicated supply chains, rebuilding new supply chains. This stuff tentatively is expected to take a lot longer than we expect. We even know that companies that supply Apple are complaining that they do not have enough wafers or that they're completely booked out of wafer supply for the next 5 years already, which is just wild. Now, we do expect to hear good news from the big players, right? Apple, Amazon, AMD, Enphase, they've all seen some improvement in chip supplies, which is really good. Part of that could be because we saw crypto prices fall. Enphase got their hands on more ASICs, which is great. But supply chains improving, while that is hope, I'm worried it's just hopium. If consumers end up with more purchasing power because of the wage price spiral, supply chains getting better might not actually matter. Consider this, folks. Omicron was supposed to slow travel and spending. What actually happened? On a month-over-month basis, so multiply them by 12 to get an annualized rate, coffee's up 2.7%, furniture's up 3 to 3.6%, dishes are up 4%, apparel's up 1%, that's on a month-to-month basis, so that's 12% annualized. Specifically, girls' clothing, which is up like 33% on an annualized basis. Video and audio products up, pet products up, recreational products up, appliances up. Holy smokes! The more good news we get from earnings, and we talked about this a few weeks ago, and this is the bottom line, the more good news we get from earnings, that people are spending more and more money, and the more news we get that real wages are actually now rising, increasing people's purchasing power, the longer this inflation boogeyman is going to stick around, the more we're going to see 10-year treasuries bob up over 2% and potentially start running towards what people say is a cap of maybe 2.5%. But what if it's not? So I hate to say it, but we've got some issues. I know this isn't the most bullish video, but this is all I got. I really hope we go back to the moon at some point and we hit that soft landing, but I also want to be very realistic. And hopefully that's what you keep coming here for, is realism. Thanks so much for watching, and we'll see you in the next one. And make sure to go to metkevin.com/extra to learn more about that extra debit card. Thanks so much, folks. Bye.